Welcome to InvestorWeb, the channel where your financial insights broaden and your investment skills sharpen. Here at InvestorWeb, we pride ourselves on delivering top-tier financial advice and insights, tailored especially for challenging economic times. Whether you're a seasoned investor or just starting out, our content is designed to equip you with the knowledge and strategies you need to thrive. Today, we delve into a critical topic: navigating the murky waters of recessions. First, what exactly is a recession? In the simplest terms, a recession is a significant decline in economic activity across the economy lasting more than a few months. It's typically visible in real gross domestic product, real income, employment, industrial production, and wholesale retail sales. During a recession, you'll often see a noticeable dip in the gross domestic product, a rise in unemployment rates, and a decrease in consumer spending as people tighten their belts in response to economic uncertainty. With a clear understanding, let's explore how to effectively maneuver through these times. Scene script. Rule number 1, boost your emergency fund. In the unpredictable dance of the economy, the tempo can sometimes change unexpectedly. It's during these moments that having a robust emergency fund becomes more than just a good idea. It becomes essential. Think of it as the financial equivalent of an umbrella in a rainstorm. Imagine this. Job markets might wobble. Industries could face downturns, and unforeseen expenses are always lurking around the corner. Here's where an enhanced emergency fund steps in, offering not just peace of mind, but a practical buffer against these financial downpours. Historical examples abound where individuals with substantial emergency reserves were able to navigate recessions without the need to liquidate investments at a loss or incur high-interest debt. This financial cushion enables you to cover essential expenses for several months, from mortgage or rent payments to groceries and utility bills, without additional financial strain. An ample emergency fund is your financial safety net in turbulent times. Rule number 2, diversify your investments. Imagine you're at a buffet. Instead of filling your plate with just one dish, you sample a bit of everything. That's the essence of investment diversification. It's about not putting all your financial eggs in one basket. By spreading your investments across various asset classes such as stocks, bonds, real estate, and perhaps commodities, you're not just chasing potential returns, but you're also cushioning yourself against the volatility of the markets. For instance, when the stock market is down, bonds might still be performing well. Real estate could be holding its value or even appreciating. This blend of different assets can help stabilize your investment portfolio, reducing the risk of significant losses. Consider this. During economic downturns, sectors react differently. While tech stocks might plummet, consumer staples or healthcare could hold steady or even gain. By diversifying, you're essentially ensuring that a downfall in one area doesn't spell disaster for your entire portfolio. Diversification is not just a strategy, it's a safeguard. Rule number 3, focus on quality stocks. In the tempestuous sea of market fluctuations, especially during a recession, the beacon that often shines the brightest is that of quality stocks. Investing in companies with robust fundamentals, those with strong balance sheets, consistent earnings, and reliable management, is akin to building your financial house on rock instead of sand. Why does this matter? Well, companies that exhibit these characteristics are better equipped to weather economic storms. They can maintain profitability and even seize growth opportunities when weaker competitors may struggle or capitulate. It's these companies that not only survive, but can thrive, emerging stronger on the other side of economic downturns. Moreover, focusing on quality stocks encourages a disciplined investment approach. It helps investors steer clear of speculative bets on high-risk, high-reward stocks, which can be akin to gambling in turbulent times. Remember, it's not just about surviving a recession, but positioning oneself to capitalize on the recovery. Quality over quantity can lead to sustainability and growth, even in a recession. Rule number 4, avoid panic selling. When the market starts to plummet, it's like watching the speedometer drop in freefall. Terrifying, isn't it? But here's where seasoned investors play it cool. The instinct to sell everything can be overwhelming, but history tells us that this could be a costly mistake. Take, for instance, the global financial crisis. Many who sold their stocks in a panic in 2008 saw the market rebound even stronger in the following years. Those who held on not only recovered their losses, but often saw significant gains. Why does this happen? Well, markets are cyclical. After every downturn, there typically follows an upturn. Selling in a panic locks in losses and means missing out on the inevitable recovery. It's like leaving the party just when the band starts playing your favorite tune. Instead of being swayed by fear, consider a strategic approach. Review your investment portfolio with a focus on long-term goals, not short-term fluctuations. Stay the course. Patience is a virtue in investing. Rule number 5, keep investing. In the throes of economic downturns, when the market seems like a ship in a storm, the instinct might be to pull all funds and wait out the tempest. However, history and strategy suggest otherwise. Continuing to invest, particularly during a recession, can be a golden opportunity for the astute investor. Let's talk about a concept known as dollar-cost averaging. This strategy involves investing a fixed amount of money into a particular investment at regular intervals, regardless of the share price. During a recession, when prices are generally lower, this method allows investors to purchase more shares than during high market periods. Over time, the cost per share can average out to be lower, maximizing potential gains when the market recovers. It's akin to shopping during a sale. The discounts you get now could lead to significant rewards later. Remember, the market's downturns are not permanent but cyclical. Consistent investing can lead to buying opportunities during downturns. Let's speed up with Rules 6 to 10. Starting at Rule 6, refinance debt. During recessions, interest rates often fluctuate, presenting a prime opportunity to refinance existing debts. This can lower your monthly payments significantly, freeing up cash for other essentials or investment opportunities. For instance, refinancing a mortgage when rates drop could save hundreds per month, which adds up to a substantial amount over the life of the loan. Moving on to Rule 7, enhance your skill set. Economic downturns often shift job market demands, making it crucial to stay adaptable. Investing time in learning new skills or enhancing existing ones can safeguard your employability. Consider online courses or certifications in high-demand areas. Not only does this improve your resume, but it also boosts your confidence and keeps you proactive. Rule 8, stay informed. Knowledge is power, especially in uncertain times. Keep abreast of financial news, market trends, and economic indicators. Understanding the broader economic environment helps you make informed decisions and spot opportunities where others see obstacles. For example, knowing which sectors thrive during a recession can guide your investment choices. Next, Rule 9, plan for recovery. Recessions are not permanent. Those who plan for the recovery phase are often the quickest to capitalize on it. Set long-term goals and prepare to act when the economy begins to rebound. This might mean having capital ready to invest or ramping up business operations at the right moment. Lastly, Rule 10, seek professional advice. Navigating a recession can be complex, and there's no shame in seeking help. Financial advisors can provide personalized advice tailored to your specific circumstances. They can help craft a strategy that aligns with both your immediate needs and long-term objectives. These rules equip you with a strategic approach to not just survive but thrive during economic downturns. To recap, today we've covered the 10 essential rules for navigating through recessions. First, enhance your emergency fund. It's your financial safety net. Second, diversify your investments to mitigate risks. Third, prioritize quality stocks that withstand economic downturns. Fourth, steer clear of panic selling. It's a short-sighted move. Fifth, continue investing even in small amounts to take advantage of market recoveries. Moving on, sixth, reduce unnecessary expenses to tighten your financial belt. Seventh, revisit your financial goals and adjust strategies accordingly. Eighth, keep an eye on the market trends but don't be swayed by every ripple. Ninth, educate yourself about financial management. Knowledge is your best defense. Lastly, maintain a long-term perspective to see beyond the immediate turmoil. Navigating a recession requires a blend of prudence, patience, and persistence. Remember, wisdom in recession is as valuable as courage in crisis. Subscribe to Investor Web for more insightful financial guidance. Stay prepared, stay informed.